Welcome to my Accounting 1110 Review for Final, Chapter 9, Part 4. In this pencast, we're going to look at the topic of notes receivable. Notes receivable can come about from a variety of transactions. We can sell someone something and have it be a longer term or bigger dollar amount. So we would make an entry, we'd have them sign a note, as it offers us greater protection. You can go to court with a note, and the note says, I formally promise to pay so-and-so. It also has an interest rate to it, so a lot of good things happen. Notes receivable can come about from a sale, where you say notes receivable and sale. It's one way notes receivable can come about. Another way notes receivable can come out is you can lend someone money. Someone might ask me to lend them some money, and I can debit notes receivable for the amount that they owe me and credit cash, and I can lend them some money. So another way accounts receivable can come about is just from lending money. Can also be used as a pretty nifty collection technique. Let's say someone owes you $10,000. You sold them on credit, $10,000 worth of merchandise, and it's gotten a little old and you're worried. You could contact them and say, hey, I can see you need a little more time. How about you pay me $3,000? And I'll set up a notes receivable with a nice interest rate for you for the difference, and we'll clean up your accounts receivable. And you'll have more time to pay, and I'll earn a little interest. So notes receivable can come about from an accounts receivable transaction that was getting a little old. Those are the three ways, generally, that notes receivable can come about. It gives you an idea of how we get them. So a notes receivable is a formal, written promise to pay. Much better to go to court with if you have to, if you have a notes receivable. They always include interest. So now we're going to earn a little bit of interest on this. And they also include a due date. Let's use an example of a $10,000 notes receivable. Let's say it earns interest at 9% and it's due in 90 days. It's a 90-day note. The 9% is assumed to be for a year. The face amount of the note is $100,000. The length of the note is 90 days. To calculate what interest would be on the note, it's principal times rate times time. Our principal is $10,000. Our rate is 9% for a year, and our time in our example is 90 days out of a year. Be careful to use 360 days, since there's 360 days in a banker's year. I don't know why we use banker's year. It'd make more sense to me if that was 365, but it's not. So, what is the interest on this? Do the math. 10,000 times 9% is 900 times 9 divided by times 90 divided by 360 tells you interest on this note will be $225. That is $10,000 at 9% for 90 days. This is total interest. The maturity value of the note is another term used a lot in accounting. Let's say the maturity value is principal of the note, in our case, the interest, and the maturity value is $10,250. Let's make the entries for this note. First of all, we'll use it to just be a borrowing note where we're lending someone money. So we'll say notes receivable, $10,000, and cash. Let's further decide. This note is dated April 14th. That's the entry to record the note. When is this note due? Well, we need to calculate that. There are 30 days in April, and we signed it on the 14th. So the note was held in April 16 days. Don't count the date it was issued. In May, it would be held 31 days. So there are 31 days in May. We're now up to 47. In June, it would be held 30 more days. We're up to 77. We only need to get to 90. How many days do you need to get from 77 to 90? And that will be the day it's due in July. The answer is 13th. So the note is due on July 13th. So on July 13th, we can expect to collect it. We'll get cash, the maturity value, the amount of $10,250. We'll collect interest revenue in the amount of $250, and we'll take off our notes receivable for $10,000. And that would show the entries that would be required for this note. Not so bad. What would happen if they didn't pay? And on the 13th, this entry never happened. This would be said to be in default. If you're in default, that means you didn't pay. And it would change our entry. Immediately, we would take the amount into accounts receivable, because we would not have made the above entry, they didn't pay. We would take the entire amount into accounts receivable. So we'd make a very similar entry, only not into cash, into accounts receivable. Take it out of notes receivable and immediately begin collection activities. It's understood that any amount shown in notes receivable is a current note, and it's not past due. Let's do a slightly harder version of this note, shall we? Let's still have a note due in the amount of $10,000. Let's still use interest of 9%. And let's have it be a 90-day note again, but this time let's have it issued, lend them the money, on November 11th. That's going to change things because I have a December 31st year end. So on November 11th, I issue this note. On December 31st, I have a year end, and somewhere out in the future, I'm going to get paid. Well, first of all, let's determine the due date, shall we? It was issued in November, and there are 30 days in November 11th. So we held the note 19 days in November and 31 days in December. That means we held the note 50 days during this accounting period. Let's label that 2013. January has 31 days. The note will then be 81 days old. And February will need 9 more days to get to 90. So the note will be due February 1st, or February 9th. So if it's a 90-day note in total, and I hold it 50 days in 2013, 90 minus 50, means I will hold it 40 days in 2014. Again, those must equal 90 because it's a 90-day note. 50 in 2013, 2014. What are the entries required now with this new set of facts? Well, on November 11th, we issue the note and lend the money. So we'll say debit notes receivable and credit cash. $10,000. Now we need to make an adjusting entry on the 31st to accrue 50 days worth of interest being earned. Let's calculate that interest. It's a $10,000 note, principal, times rate, times time. This time it's 50 out of 360. You'll never use 90 days in that lower in the denominator. It'll always be a year. So how much interest have we earned at this point? Work through that math and you see it comes to $125. So interest as of year end is $125. And I'll say interest receivable and interest revenue. It's an adjusting entry. It's done at year end. Like all adjusting entries, it's the balance sheet, sets up a receivable for $125, and hits the income statement for $125. That gets $125 of the interest I've earned in the right period. How much is interest from December 31st to February 9th? Well, 10,000 times 9% times the remaining 40 days would tell us how much interest is in the second year. Work that through, and just as you suspected, it's a little less. It'll be $100. What will total interest on this note be? This is for the period November 11th to year end. This is interest for the period year end through February 9th. Logic would tell us it would be the sum of those two. Let's check. 10,000 times 9% times the whole amount, 90 days over 360, equals 225. So you can say 125 is earned in 213, and we have that showing. You can say 100 is earned in 2014, and you can say total interest for this will be 225. What then is the entry on the due date? Put this on pause and show me the entry you would like to make on February 9th, and then come back and let's see how you did. Here's my entry. I picked up the total amount of cash at the maturity value, $10,225. I got rid of the receivable of $125 I set up at year end on 12/31. I picked up $100 worth of interest revenue, like I said I would for the new year, and got rid of the notes receivable. Notice, it ties exactly to my interest calculations. My total interest for the whole period was $225, 125 in the first part, and 100 in the second part, based on days. How did I get the days? Up here under due date. I came up with a total as of December 31st and used that for my adjusting entry, and then I calculated my due date as February 9th, and the difference between 50 and 90 was 40. Hey, thanks for joining me for this quick demo on notes receivable.